In 1929, the stock market crashed and erased a generation's wealth. In 2008, the housing market imploded and nearly took the global economy with it. But 2025 is different. This time, everything, stocks, bonds, and real estate, is cracking at once. The signs are flashing red, the patterns are identical, and the tools that once saved us are gone. Welcome to the everything bubble, where history isn't just repeating, it's escalating. History doesn't repeat, it warns. In 1929, the stock market crashed, wiping out 89% of its value over 3 brutal years. Banks failed, savings vanished. 1 in 4 Americans lost their jobs, and it took 25 years for markets to recover. Fast forward to 2008. The housing bubble burst, stocks plunged 57%, and 10% of the workforce was unemployed. Trillions evaporated overnight. Each time, the system barely survived, patched together by bailouts, cheap money, and luck. But now, those same lifelines are gone, and the storm forming in 2025 makes both crises look like warm-ups. The everything bubble. 2025 isn't just another market correction, it's a perfect financial storm. For the first time in history, stocks, bonds, and real estate are all inflating together, fueled by cheap debt, speculation, and denial. Economists are calling it the everything bubble because when everything rises at once, everything falls together. There's no safe haven left. The warning lights are blinding: overvalued assets, record debt, and exhausted government tools. The crash window? November 2025 to June 2026. The mathematics are cold, the indicators precise.
And when this financial bubble bursts, there will be nowhere to hide.
The tools are broken. In previous crashes, the Federal Reserve and the U.S. government had weapons to fight back: lower interest rates, print more money, bail out the banks. But in 2025, every one of those tools is dull. Rates can't be cut to zero. They're already close. Printing money caused the worst inflation in 40 years. And the government? It's buried under $36 trillion of debt. The rescue options that saved Wall Street in 2008 are off the table. This time, when the system cracks, there's no safety net, only gravity, mathematics, and panic. 3 bubbles, 1 explosion. Every past crash came from a single bubble: stocks in 1929, housing in 2008. But 2025 is unique because we're sitting on 3 bubbles inflating at once. Stocks are priced for perfection, real estate is more overvalued than before the Great Recession, and bonds, the supposed safe haven, are collapsing under record government debt. Each one is dangerous on its own. Together, they're a financial time bomb. When these markets finally crack, they won't just fall. They'll pull each other down in a chain reaction the world has never seen before. The fragile giant. The stock market looks unstoppable on the surface, but underneath it's held up by 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. Together, they make up nearly 1/3 of the S&P 500's total value, an imbalance not seen since 1929. When a few stocks carry the entire market, stability is an illusion. If even one of these giants slips, the shock ripples through every index, every portfolio, every retirement account. This isn't diversification, it's concentration disguised as confidence, and it's setting the stage for a collapse faster than anything in history. The AI mirage. Nvidia has become the poster child of 2025's insanity. Valued at over $3 trillion, it's now worth more than the entire German stock market. Investors are paying $65 for every $1 the company earns, all because of blind faith in artificial intelligence. It's the same story as 1999, when everyone believed the internet would change everything, and it did, just not for the companies people bet on. The AI boom isn't a revolution, it's a rerun, speculation dressed up as innovation, with history quietly whispering the same warning: bubbles burst louder than they grow. The crumbling foundation. Beneath the glitter of record home prices lies a disaster waiting to unfold. Housing is now roughly 50% above its historical trend, making it even more overvalued than the 2008 bubble that nearly destroyed the global economy. But this time, the danger isn't just suburban mortgages, it's towering downtown offices standing half empty. As leases expire and remote work becomes permanent, commercial buildings financed at 3% interest are being refinanced at 7 or 9. The math doesn't work. Defaults are coming, banks will bleed, and the concrete pillars of the economy are already cracking. The safe haven that isn't. Bonds were once the anchor of safety, the place investors ran to when everything else fell apart. Not anymore. In 2025, government debt has become the problem, not the protection. The United States owes over $36 trillion, and the annual interest alone now exceeds $1.2 trillion, more than defense, more than Social Security. Every new dollar borrowed pushes rates higher, feeding a vicious cycle of debt and inflation. When the risk-free asset itself starts collapsing, the entire financial system loses gravity. Bonds can't save you this time. They're sinking with everything else. Echoes of 1929. In 1929, everyone believed technology had made crashes impossible. In 2025, we're telling the same story with AI. Margin debt is at record highs, stock ownership is universal, and the top 1% controls a third of all wealth. When the market breaks, half the country loses savings overnight. The difference this time? No one's on the sidelines. The illusion of safety through index funds and diversification will vanish in days, proving that history doesn't repeat, it just updates the software. Built on borrowed time, debt is now the foundation of everything: corporate profits, housing prices, consumer spending. Auto loans stretch 7 years, credit cards charge over 20%, and corporations are leveraged beyond reason. When interest rates doubled, the math stopped working. The entire economy became a balloon held up by IOUs. $600 trillion in derivatives hang over global markets, waiting for a single shock. The next crash won't start in one sector. It'll detonate everywhere at once. Debt isn't just a problem anymore. It's the business model. The domino moment. It won't begin with panic. It'll begin with a headline. A tech company misses earnings. A regional bank pauses withdrawals. Then algorithms take over. Margin calls hit. Institutional selling cascades. Within days, trillions vanish. The Fed can't cut rates without reigniting inflation. It can't hold steady without deepening collapse. Every option triggers another crisis. The machine runs on confidence, and confidence is the first thing to go. What follows won't be a correction. It'll be a reckoning powered by automation and fear. The reckoning. When the dust settles, it won't look like a recession. It'll look like reset. Stocks down 70%, homes down half, retirement savings erased. The safety nets will tear, and the middle class will find out how thin they were. The real damage won't be financial, it'll be psychological. Trust, once broken, doesn't recover quickly. The world learned that in 1929, forgot it by 2008, and will relearn it in 2025. The pattern that ends empires. Every major empire doesn't die by invasion first. It bleeds out through its money. The sequence is boringly consistent. Military overreach, permanent deficits, currency debasement printing, inflation, loss of confidence, collapse. Rome did it. Spain did it with silver. Britain did it with the pound. Each one insisted, this time is different. It never was. In 2025, the United
US
States
dollar
is marching
isn't just
through the same
America's
stages
currency.
with a
It's the
reserve
world's.
currency that props up the whole world. The only meaningful questions now, where are we on the curve? Early decline, mid-spiral, or endgame? And how fast does confidence snap once markets realize the tools that saved 1929 and 2008 are spent? Rome. Debase, inflate, disintegrate. Rome's denarius began as trusted, near-pure silver. Then came costs. Legions, roads, frontier wars, palaces. Nero clipped purity to make more coins. Later emperors slashed silver content from 100% to 5%. Wages stayed nominally the same. Purchasing power died. Prices exploded. Farmers bartered. Soldiers demanded gold or goods. Tax collection seized up. The borders didn't collapse first. The money did. Without a functional unit of account, Rome couldn't pay armies or maintain administration. By 476, the Western Empire was a skeleton. Lesson: when you monetize deficits by debasing the unit, you don't stimulate. You detonate the system that coordinates production, pay, and trust. Spain, drowning in silver. Spain found a cheat code: oceans of New World silver. The Peace of Eight became global money, but flooding Europe with metal didn't create real wealth. It inflated prices. Spain imported goods instead of building industry while waging multi-front wars. Debts ballooned. Defaults came in 1557, 1560, 1575, 1596. Creditors demanded returns Spain's economy couldn't earn. Coinage quality slipped. Credibility died. The empire wasn't resource poor, it was discipline poor. Silver bought time, not solvency. When your revenues depend on extraction and your spending depends on prestige wars, the currency becomes the release valve. It bursts. Spain slid from hegemon to has-been within a century. Britain, from power to decline. For more than 200 years, Britain's pound was the world's strongest currency. It was backed by gold and trusted everywhere, fueling trade across the empire. But World War I changed everything. The war cost far more than Britain could afford, and the country borrowed heavily to survive. When the government tried to return to the gold standard in 1925, it overvalued the pound, making exports too expensive and causing mass unemployment. By 1931, Britain gave up the gold standard completely. Then World War II pushed the country deep into debt, owing more than twice its entire yearly economy. In 1944, the US dollar replaced the pound as the world's main currency. After that came a painful decline, multiple currency devaluations, rising inflation, and shrinking global influence. Britain didn't lose its empire in battle. It lost it when the world stopped trusting its money. America, from gold to printing press. After World War II, the US dollar became the world's main currency. It was backed by gold and other nations trusted it completely. But over time, America started spending more than it earned on wars, government programs, and global bases. By the 1960s, countries noticed the US was printing more dollars than it had gold. In 1971, President Nixon ended gold backing completely. The dollar became just paper, valuable only because people believed in it. Since then, America has printed trillions to cover its debts, and each round of easy money makes that belief a little weaker. The pattern never changes. Every collapsing empire follows the same 7 steps. First comes power and trust, then expansion, overspending, money printing, inflation, loss of confidence, and finally collapse. Rome debased its silver coins. Spain flooded Europe with silver. Britain left gold and inflated the pound. America prints dollars without limits. Each empire thought it was unique, but the math never changes. You can't spend forever without earning, and you can't print wealth. The United States is already deep in stage 5, inflation and growing doubt. What comes next is always the same. People stop trusting the currency. Why 2025 is different. When Rome fell, it was mostly Rome that suffered. When Britain collapsed, only its empire felt it. But the US dollar isn't just America's currency, it's the world's. Every country trades and borrows with it. That means when the dollar weakens, everything shakes. The US now pays more in interest each year than on its military or social security. The Fed can't cut rates without fueling inflation and can't raise them without crushing debt. There's no easy option left. When confidence in the dollar fades, it won't just be an American problem, it'll be a global one. The everything bubble. In 1929, it was stocks. In 2008, it was housing. Now, it's everything. Stocks are overpriced, real estate is overvalued, and bonds, the safe investment, are collapsing under government debt. When all three fall together, there's nowhere to hide. Portfolios crash, pensions shrink, and confidence disappears. The old system of stocks up, bonds down doesn't work anymore. The markets are like a three-legged stool with every leg cracking at once. When it finally breaks, the damage won't be local. It'll hit every country tied to the dollar. The confidence game. Currencies don't collapse overnight. They crumble slowly, then all at once. It starts small. A missed payment, a bad bond auction, or a banking scare. Then investors panic, algorithms sell, and the system snowballs. The Federal Reserve prints money to calm the markets, but each bailout destroys more trust. Foreign countries begin trading in other currencies. Businesses raise prices faster, and savings lose value. Confidence is like glass. It doesn't bend, it breaks. When it's gone, printing more money can't bring it back. Three possible futures. History gives three outcomes. First, slow decline, like Britain after World War II, where the empire shrinks but survives. Second, sudden collapse, like Rome, where the economy breaks and chaos follows. Third, reset and rebuild. A new currency system replaces the old one, possibly tied to gold or digital money. The United States could still choose the first or third paths if it faces reality soon. But if it keeps printing, borrowing, and denying the math, history's pattern says the second path is waiting. What collapse feels like? It doesn't start with explosions. It starts with emptier wallets. Groceries cost more, paychecks buy less, savings disappear, and jobs become scarce. The government cuts services while taxes rise. Retirements vanish as markets fall. People lose trust in leaders, in banks, and in the future. It's not a single event. It's a slow erosion of normal life. One day, people realize their money doesn't stretch far enough, and by then, the damage is already done. That's what collapse looks like in the modern world. How to avoid the fall. Every empire that survived made one hard choice: discipline. Spend less, rebuild industry, restore trust in money. The United States could still change course, limit debt, control spending, and back the dollar with something real again. It would mean sacrifice and fewer luxuries, but it would save the system. History is clear. Those who face the truth early adapt. Those who ignore it fall fast. After the everything bubble and the fragile finance piece, this one asks a simple question. What do we actually do with gold? Imagine every bar stacked into a single cube, shiny, finite, and oddly ceremonial. People buy it to sleep better at night. Governments hoard it to show strength. Jewelers turn it into bling. Industry uses tiny slivers in electronics. But mostly, gold is a story we all agree on. It's insurance, status, and psychology wrapped in metal. In a world where paper promises fail, that preserves value when chaos arrives. Billions of years before banks, markets, or bubbles, gold was born in chaos, the kind that ripped stars apart. When massive stars exploded, they forged heavy metals like gold and flung them across the universe. Some of that cosmic debris landed here, sinking deep into Earth's crust. Over time, rivers carved through rock, revealing tiny flashes of yellow sunlight buried in the dirt. Humans noticed. They didn't know it came from space, only that it was beautiful, untarnished, and rare. Long before it became money or a hedge against collapse, gold was simply stardust that refused to fade. When early humans began trading, they started with what made sense: cows, salt, barley, things you could eat or use. But these weren't easy to carry, divide, or store. Then came gold. It didn't rust, it was rare but not impossible to find, and it could be melted, shaped, and weighed. More importantly, it looked eternal. People didn't need it to survive. They needed to believe in it, and that belief spread fast. Suddenly, shiny metal replaced cattle as the foundation of trust. Gold wasn't practical money, it was psychological money, value powered entirely by collective faith. As civilizations expanded, gold stopped being just decoration. It became order. Rulers began stamping their faces onto coins, turning beauty into authority and metal into money. Suddenly, trade didn't depend on trust between strangers. It depended on the ruler's promise carved into every coin. Uniformity created confidence. A coin from Athens or Persia meant something. Merchants could travel, buy, and sell without barter or guesswork. Gold had evolved from symbol to system, from ornament to engine of empire. Every shiny coin wasn't just currency, it was propaganda, proof that power, faith, and value could all fit in your hand. By the 15th century, gold wasn't just wealth, it was obsession. When Spanish conquistadors landed in the Americas, they didn't see civilizations, they saw glitter. The Aztecs used gold for worship and art, not currency, but to Spain it meant power. They melted temples into coins, filled ships with treasure, and fed an empire built on greed. Mountains of gold sailed east, funding wars, cathedrals, and monarchs who believed their rule was divine. But all that gold came at a cost: conquest, slavery, collapse. What began as beauty had become blood money, fueling centuries of empire and exploitation. By the 19th century, hauling gold around was impractical, so banks created a shortcut: paper promises. You'd hand over your gold, and they'd give you a note that said, "We owe you this much." It was lighter, faster, and safer to trade. 1 ounce of gold equaled $20, and as long as people trusted the banks, paper worked just like metal. But this was the first great illusion of modern finance, that paper and gold were the same thing. The system now relied on faith, not metal. The moment that faith cracked, everything behind those notes would crumble. In the early 1900s, bank panics were constant. People would rush to withdraw their money, terrified the bank wouldn't have enough gold to pay them back. So the United States tried something new: one bank to rule them all, the Federal Reserve. It would control the flow of money, step in during crises, and keep smaller banks from collapsing. At least, that was the idea. But with that power came temptation. Once you can print money to stabilize the system, you can also inflate bubbles, delay pain, and quietly shift control from markets to a single institution. By the time the Great Depression hit in the 1930s, the gold standard had become a trap. Every US dollar was tied to a fixed amount of gold, which meant the government couldn't print more money to revive the economy. As banks failed and panic spread, people hoarded gold, draining reserves and freezing trade. President Roosevelt made a drastic move. He ended the public's right to exchange dollars for gold. It was controversial, but it worked. The economy slowly recovered, yet something fundamental changed. From that moment on, money was no longer metal, it was trust, pure belief. After World War II, the world was broke, except the United States. So in 1944, global leaders met in Bretton Woods to rebuild the financial system. Their solution: make the US dollar the center of everything. Every other currency would tie its value to the dollar, and the dollar itself would be backed by gold at $35 an ounce. It sounded perfect: stability, trust, and order under one currency. But it also gave America enormous power to print, lend, and dominate global trade. The dollar became as good as gold until the world discovered it wasn't. In 1971, President Richard Nixon broke the final link between money and gold. Foreign nations had started demanding real gold for their US dollars, and America didn't have enough to deliver. So Nixon went on television and announced that the dollar would no longer be redeemable for gold, ever. Overnight, money became pure faith. No metal, no backing, just government decree. Economists called it a fiat system, but in practice it meant this: if the government needs more money, it can simply create it. That freedom reshaped the world economy and quietly made inflation a permanent feature of modern life. Today, gold isn't about fashion or even tradition, it's about fear. When currencies wobble, when governments print money like confetti, investors run back to the one thing they can touch. Central banks are quietly stockpiling gold again, especially in countries like China, Russia, and Turkey. They see it as protection from a dollar-dominated world that feels less stable by the day, and it's not just nations. Regular people are buying coins, bars, even digital tokens backed by gold. In a world built on paper promises and fragile trust, the ancient metal has once again become the ultimate just-in-case. Gold feels safe because it's simple, solid, timeless, untouchable by politicians or algorithms. But that safety comes with trade-offs. Gold doesn't pay interest, it doesn't innovate, and when markets boom, it just sits there. It's protection, not progress. Still, in times like these, debt crises, inflation, collapsing trust, it does what it's always done: waits. That's why the smart investors don't go all in or all out. They balance. A little gold for defense, a little risk for growth. Because history is clear: empires fall, currencies fail, but cycles always reset. The real question isn't gold versus paper, it's survival versus opportunity.